Hello and welcome everyone to another commentary from StashAway. With us today, our Chief Investment Officer, Freddy Lim. Hey Freddy, how are you doing?
Hey Philip, how are you? A big hi from Japan.
It's so good to see
So
you be able to make your way over to your family. So very excited. And yeah,
absolutely, the reopening is happening in a lot of places in the world, and I hate to say this for people who's not here. It's cherry blossom time. It's beautiful.
I can imagine. I saw some pictures already on across all the social channels. So yeah, so it's looking beautiful. But hey, I'm envious of you because I think one of my last trips to Japan was actually with you. So a few years ago. But hey, Freddie, lots of things are happening. Obviously, the big news this week, what everyone was waiting for, was the Fed minutes from the March meeting, from the March FOMC meeting, were released today as we record this on Wednesday, the 6th of April. Um, so with that being said, maybe you can talk a little bit about what happened in the minutes and what kind of impact it had this week already on markets.
Well, the minutes basically affirm the Fed's concern over inflation and their determination to keep it in control. As you know, their long term target is the natural equilibrium is around 2.5 percentage point. Because of the new framework of using averages, maybe 3% is still comfortable. Today we're talking about headline at 7.8% year on year and 6.4% in the core inflation. The PCE is a different number, but I'm just talking about the consumer trends here. It is a concern even if you exclude the impact of fresh food and energy. So they probably felt compelled to do something about inflation right this very moment.
No, absolutely. And I think with that being said, right, I think you wanted to also, we talked about a little bit before we went live, is explain. We talked about it a lot of times in probably a year, 2 years ago, when obviously during COVID, when it first started, and markets were dropping, the Fed was stepping in, right? We talked a lot about the money multiplier. Maybe you will refresh that a little bit for the listeners and see where does it stand right now and why is that an important indicator.
Yeah, that's a very good point. The money multiplier works both way. Suppose it's pre-crisis it was at 5.5 times. That means every single dollars that the Fed has pumped into the banking system will over time in a few months grow towards $5.5. So that's a money multiplier effect. That effect came from the fact that our banking system is a fractional one. If there's $100 in the banking system, the banks will only need to hold a certain fraction of it in reserve. As new money comes in, a fraction of it goes into reserve. Majority amount of it can be lent out again, and the cycle multiplies money a couple of times. So that's a money multiplier. Now it works the other way too. When the Fed is withdrawing liquidity or selling the balance sheet in this case, so the so-called quantitative tightening is essentially reducing the holdings, the assets that the Fed has purchased over the years as part of their multi-year support to the economy. So they need to wind that down. Every dollar withdrawn, well, through the money multiplier process, result in a certain impact on the money supply and hence on the economy. And at the moment, the money multiplier, whether it's M1, which is more narrow, or M2, which is broader, they are at all-time low. So I mentioned 5.5 times just before COVID. It's gone down to 1.3 times in M1 and 1.11 times in M2. So what it means is quantitative tightening's impact is also a lot more muted than in the past. This is the right time to do so. But obviously, the market has to digest this new piece of development.
No, absolutely. And that's what we're seeing in the first few days of this week. With the anticipation of the Fed, and with the Fed, markets have started to go down a little bit after a couple of weeks of like a refreshed up slope, right? Freddie, you talked a little bit about the money tightening and what the Fed is going to do. We talked about why they're doing it, right? Inflation is running amok a little bit. So a lot of times people argue, or you hear a lot of people will probably have read this before, is that like, oh, the Federal Reserve, if they don't get the Fed rate hike, if they don't get the rate hikes correctly done, it ends usually up in a recession, right? Historically. So, and there's a secondary part to this question, and is normal. Let's say, for example, they start hiking rates, and then we're seeing equity markets drop, right, by 10, 15, 20, maybe even 30%. Who knows, right? What's going to happen? Where is that threshold of equity market downside risk that the Fed has to actually step back in, right?
Well, they have long history, the Fed, and in the past, they, more primitive way of communicating, and nowadays they're very experienced. Let's put it this way. So it's a bit of feedback loop between the Fed and the markets. If you see what the amount of rate hikes has been priced into the market over the last year till today, you can see it's quite artfully done, right? The Fed signaled that they need to hike a little bit, market price it in, that the market tells the Fed what they're expecting beyond the immediate. There's a whole market for different horizon going to the future. And then the Fed looks at that and say, well, okay, that's sort of reasonable. And they slowly guided the market there. So that's with the rate high expectations. You see the market now comfortably pricing in 8.9 25 basis point hikes for this year. So that means the market is already bracing for some 50 basis point hikes. So that was very artfully done. And yet here we are, the markets, a bit flattish, but we are not, it's not like a crash. It's very well done. Now, this is similar, in my opinion. It sounded a bit abrupt 2 days ago when Layer Branded came out, being the dovish member traditionally, saying that sort of shocked everyone.
Spooked it, yeah.
But you sort of you spooked. But the sort of numbers today: $95 billion, $1.14 trillion a year. The equity market is at least $48 trillion in the US. The money multiplier is 1 point something times. So you're not withdrawing a lot in terms of liquidity out of the markets. So that's manageable at the moment, right? So I think the Fed is playing a game of signaling a little, testing the response of the market. If it's healthy enough, they will try to push it again, right? And ultimately, as long as there's earnings potential, there's earnings momentum in the equity markets, rate hikes would not interfere with that, right? So, like Warren Buffett famously coined the term synthetic bond. You can think about the stock market as a very long-dated bond. Every year, the cash flows your earnings or expected earnings. If your earnings peak and you have an interest rate hike, yes, 1% of interest rate hike can reduce the equity market by 15, 16%, right? But as long as earnings momentum is there, and that provide cushion and impact. And that's sort of what we see in the equity price action right now, right? Who knows what's going to happen tomorrow, but investors need to take this very long-term view, going back many cycles, and say, how has the Fed been doing this before? It's not like every rate high cycle or a recession. In fact, the way it's done now is signaling, testing the response, and then adjust the expectations. That approach is a lot safer than in the past, in my personal opinion.
Yeah, and being open about it, right? The markets, just, if they know about things, they usually price these things in, and it's a lot less of a surprise, right? So I think that's really important. And then I want to ask you one other question that just came to my mind while we were talking about this. I think, earnings have been okay this year still, right? I think you see a lot of companies taking the not advantage, but they have to, because obviously raw materials have, inflation has caught up, right? And are passing it on to the consumer by raising prices. You see it across the board. If you type in any company, they probably raised the prices over the last couple of months, right? Do you think the raise in prices versus the earnings not even reflecting it, because companies will have to also probably pay, right? Because if inflation is 7 to 8%, and an employee is getting like their 1 to 3% normal merit increase, so to speak, it's not keeping up. And I think that's when the economy will start seeing it, if the end consumer can't buy things because they didn't get enough raise. Do you see is there any relation, you think, between all of this, or not really?
So this is a great dynamics, right? If I'm a company, I look at my costs, which includes a lot of wages. That increase in cost base, is my earnings potential growing faster? And right now, if you look at equity markets, the healthy thing is not the expansion of PE multiples, but the expansion of earnings per share. So that is still very healthy. And at the moment, they're sort of able to overcome or manage the situation of cost increases. But if the Fed does not do anything about it, in a year later, going more forward looking, those companies' quality of earnings will start coming down. So to move the market forward on a healthier manner, it's actually the Fed's interest and the economy's interest that we do some sort of tightening now while we can, while the money multiplier is low, right? So in a way, we shouldn't overreact to it. We should always stick to the long-term plans. Portfolio should not be unidimensional to just the stock markets tracking it. It should be multi-asset, super diversified, not geography, but also asset types, which is what we have been doing since the 2-3 reoptimizations we've done last year and this year. So those are very important things.
Super important, because that really, it really shows also in more volatile markets the benefit of it, right? So when it's all going up, then it's not so obvious for people. But this is times like this where you really want to protect the downside, so you don't get hurt and you're in the market. You can stay in the market for the long term, right? I think that this is really, really important. So thanks again, Freddy, for sharing all your thoughts here with us. And if you want to learn a little bit more about a couple of asset classes, we have a few cool events coming up. So for our Hong Kong and Singapore audience, we actually have an event co-done with State Street and ourselves, and it's called Gold versus Cryptocurrencies. So if you want to learn more about using one or the other or both or a mix of them, you can ask all your questions during the webinar. That's on Tuesday, the 12th of April, at 7 p.m. local time. So if you have any questions or want to sign up for this, go check out our website or the links in the show notes below. And for our Malaysia audience, we have another couple of webinars on the 13th of April. That's Wednesday, 6 p.m. It's called What is Your Financial Plan B? So if you want to learn more about, estate planning and, having wills in place and protecting yourself and your family, it's a great event. I really recommend you guys joining this. And another one is on the 20th of April, so the week after, Wednesday, same time, 6 p.m. It's called an Inside Look into StashAway. So if you wanted to learn more about us, how we invest, how the app works, how we do all kinds of other things, please feel free to join, ask any questions you want. It's super interactive. Looking forward to having you there. Until then, Freddy, I wish you a wonderful time, and I'm sure we'll speak while you're still there, and I'm looking forward to that in a few weeks, okay? Thank you so much. Subscribe to our YouTube channel to get notified whenever we have new content out for you. Also, don't forget to download the StashAway app. It's available in the Apple App Store as well as the Google Play Store, so you can start on your financial journey right now.